Deductions are your friend. In general, the more deductions you have, the less tax you'll pay. You just want to make sure you're not deducting something that's not allowed to be deducted, and on the other hand, you don't want to miss any deductions and leave money on the table. Hey, my name is Mark too, and I'm a CPA who specializes in helping online sellers with taxes and with growing their businesses profitably. Today we're going to talk a little bit about what deductions are and what you can deduct in your business. A deduction is essentially a business expense that reduces your taxable income. So let's say you have sales of $10,000. If you didn't have any deductions, you'll be taxed on the full $10,000. So let's say you did have deductions and that your only deduction was a supplies expense of $1,000. With that business deduction, you'll be able to reduce your taxable income by $1,000 and will only be taxed on the $9,000 of profit left over. The IRS has a not so helpful definition of what you can deduct in your business. They say that in order to be deductible, a business expense must be both ordinary and necessary. They further clarify by saying that an ordinary expense is one that is common and accepted in your trade or business, and that a necessary expense is one that is helpful and appropriate for your trade or business. I don't know about you, but those definitions don't leave me feeling super comfortable about what I can or cannot deduct. Just know that if you incur expenses that are related to your business, they are most likely going to be deductible or at least partially deductible. But don't stop there. It's really important to educate yourself at least to a degree so that when tax time rolls around, you can at least have an idea of the things you need to check on so you don't miss anything. And speaking about educating yourself, my Reseller Tax Academy is a great option to learn in more detail about some of the tax deductions you need to be aware of and to utilize in order to optimize your tax situation. And before we dive into some of the different deductions, I want to make clear that a deduction doesn't make you whole financially. Some people are under the impression that a deduction is a way of fully recovering the amount of money spent, but it's more like a discount. Tax credits are a different story, and I'll talk about those in a different video. But let's say you want to buy a label printer for $350. That $350 is fully deductible as a business expense, but it's not $350 back in your pocket. It's just reducing your taxable income by $350. So if your sales are $1,000 and if your average tax rate is 30%, instead of having to pay $300 on the full $1,000, you're able to deduct the $350 business expense from the $1,000 to give you a profit of $650, which is your net taxable income. And 30% of $650 is a tax of $195. So instead of paying $300 of taxes, you owe $195. So the deduction is basically saving you the difference of $105. Another way to look at it is that the $350 deducted is money you otherwise would have been taxed on at a rate of 30%. So it's $105 that you don't owe. So it's essentially like you're getting a $350 printer for $245. So that's how it's like a discount. Most deductions are straightforward. Some of the most common include things like advertising, office supplies, shipping supplies, software, subscriptions, legal and professional fees, contractor fees, shipping expenses, building or warehouse rent. These are all things that are 100% deductible in the business. The most common deductions that can require some judgment include expenses such as inventory, capital expenses, auto expenses, meals, and travel. Each of these deserves their own video, but I'll briefly review them here. Historically, for most businesses, the requirement for inventory was to only deduct it when you sold it. So if you purchase some inventory for $100 this year, but you don't sell it until next year, then you don't deduct that original cost of $100 until next year. But in 2018, with the passage of the Tax Cuts and Jobs Act, it made a different method of deducting inventory more widely available, and that is the option to deduct your inventory when you purchase it, rather than having to wait until you sell it. This is what's known as the cash method for inventory. And there's a lot more there, but the main thing you need to decide is, are you using the historically required traditional accrual method for deducting inventory, or are you using the more recently allowed cash method? I have a free Facebook unit with more detail about which method may be right for you in my Facebook group, Accounting for Online Sellers. A capital expense refers to an investment in your business. One of the most common examples would be machinery or equipment that you use in your business operations. These are usually higher dollar items, and instead of letting you deduct them, the IRS requires you to capitalize them. This means they're considered to be assets rather than expenses, and the deduction comes in the form of depreciation. And depreciation is simply when you take deductions for the item over time. But most of you won't have to worry about depreciating your capital assets over time because of something called Section 179 depreciation, which allows you to fully depreciate the asset in the year of purchase. And most of you won't have to worry about Section 179 depreciation because of something called the de minimis safe harbor rule. This is an IRS rule that allows you to elect the option to immediately deduct any purchase less than $2,500. So if it's less than $2,500, you don't have to worry about capitalizing the asset or depreciating the asset. Just deduct it. You can deduct either business mileage or actual business-related auto expenses, but not both. For 2020, you can deduct 57.5 cents per business mile. Or if it's more advantageous, you can choose to deduct your actual expenses. So if you use your car 75%, let's say, for business, you can deduct 75% of your gas, maintenance, insurance, repairs, and so on. Meals can only be deducted if they are part of overnight and out-of-town business travel, or if it's part of a business-related meeting. So if you're outsourcing inventory in your hometown all day and stop for lunch, that meal would unfortunately not meet either of these requirements in the eyes of the IRS. And the meals that do qualify are generally only 50% deductible. If you travel out of town to a business-related conference or meeting, you can deduct the airfare or transportation fees, lodging expenses, 50% of the meals, and so on. Even if you take some personal time on the trip, if the primary purpose of the trip is for business, you can still deduct the travel fees to get you to and from the main destination. But if the primary purpose of the trip is for pleasure and you just happen to spend some time on sourcing or engaging in business-related activities, you can only deduct the travel costs during the trip actually related to the business, but not the overall travel to and from the main destination. As you can see, there are some tricky deductions, and for an even more extensive overview, you can use the link below to download my 31 tax deductions for resellers guide, because we're only starting to scratch the surface. Be sure to subscribe for more videos where I'll talk more in depth on all of these deductions I've talked about, and about how to get your taxes and accounting on track in your reselling business. And check out @NotYourDadCPA on Instagram for more tips and behind the scenes. Also check out the links below for more resources to help you optimize your tax situation and overcome the anxiety so you can focus on building your business profitably.